right. Good morning, everybody. I see a number of you joining us. We'll give it another minute or so just to make sure we get enough people in before we start. All right, I think we got enough people here to get going. So let's click here. Let's click here. Share my screen. And Alexandra. Okay, I'll kick it off here and then I'll turn it over to you, Alexandra. So today we're going to talk about politics and investing. This is the #1 topic that has come up when it comes to advisor conversations with prospects as well as with clients. So we figured we would share some of the content that has really resonated with the consumer. But before we get started, I will let Alexandra just kind of walk us through the disclosures here.
Sure. Good morning, everybody. Thanks for joining us. So brief disclosure, this presentation is not to be taken as investment advice and should not be relied on for such advice or as a substitute for consultation with professional accounting, tax, legal, or financial advisors. The observations made are independent of Zoe Financial and should not be read as financial recommendations. Today's host is Andres Garcia Maya, CEO and founder of Zoe Financial. A little bit about Andres. Prior to Zoe Financial, Andres was an executive director at JP Morgan Asset Management, where he helped oversee over $300 billion in assets. He is a CFA charter holder and obtained an MBA from the Wharton School at the University of Pennsylvania, where he received both the Joseph Wharton Fellowship for Outstanding Record of Academic Achievement and the Toyo Foundation Fellowship. With you, Andres.
Great, thank you, Alexandra, and thanks for helping put together the presentation. As always, you do an awesome job. All right, so just to get us started with Zoe and the mission, there's a fair amount of new folks that might be joining us on the Advisor Network. So I always start with this just to make sure we're all kind of on the same page. Right, so Zoe, our mission is to empower Americans to make better financial decisions, starting with whom they hire as a financial advisor. Right, so that's why every single one of you that's in this call went through the due diligence process. Every advisor that's in our network, the last stage is to interview with myself, as well as with Dylan Ferguson, our head of product. So it's not kind of a click the box, you're in the network. We really do take the due diligence process seriously. And I think it shows with the consumer, right? We get really strong reviews on the consumer that we have by far the best advisor network in the country. So we'll continue to deliver on that mission. So what we'll cover today. First, we'll cover investor behavior around election season, 2 historical returns around elections. And then 3 and 4, we'll talk about impact of interest rates as well as policy impacts on taxes. Because in essence, those are the ones that, in my mind, kind of the client and the prospect should be focusing on more. So those are the topics, but obviously we'll make sure to leave enough time at the end for Q&A and comments if there are from advisors within the network. Obviously, we welcome those as well. All right, so let's get started. So this is one of my favorite charts of all time. When I worked at JP Morgan, we would travel around the country and talk to a lot of financial advisors. And this is one of those really powerful charts that allows to frame conversations with clients as well as with prospects. And it talks about essentially, you could swap out retirement with college planning or whatever goal is it, but usually retirement is one of the most important goals from an investment and from a financial standpoint for clients. But the idea is that you look at the different circles. If you start with the circles that the client has the least control, they tend to be market returns, right? So you don't control what the market is going to give you. We would love to think that's the case, right? If you watch enough CNBC, you would start to maybe think that there are some people that could control it, but they can't, right? You have zero control on what the market is going to give you. Two, when it comes to policy on taxation and saving and benefits, obviously you could create a plan around it, but you don't control what taxes are going to be independently. You don't control what policy is going to be. You could vote, right, which is obviously what the elections are all about, but that doesn't mean that because you voted for something is actually going to happen. Then the things that you have some control is the type of career you choose, the education you choose in order to increase your earnings potential, and then how long you work. You have some control over that. Obviously, health is a consideration. There's a lot that comes kind of with the DNA lottery, but hey, if you don't smoke, if you don't drink, if you sleep well, you do increase your chances to live longer, right? So these are some of the areas that you have some control. And then these are the areas that you have close to total control, right? Or total control. One is how much you spend versus how much you save. And then lastly, where you invest from an asset standpoint, what the asset allocation looks like, and in which vehicles from a tax preferred versus taxable accounts, for instance, what location you choose for your assets. And as everyone in this call knows, the reason that the network focuses on planning-centric firms is that planning-centric firms focus on the things that the client actually has more control. But this is a great chart. When people start talking about what type of returns are you going to be able to give me and blah, 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 and it's not their fault, right? That's all they read in the newspapers. That's all they see on CNBC. They think that that's actually what matters. When you show that chart, it's like, look, you have no control over that. We're not going to focus all our resources on trying to beat the market that you have zero control what's going to give you. We're going to focus our resources on the things that you actually have control. And I think it's a great framework, especially with the idea of the election and a potential change in administration or continuation of the current administration. It's a great kind of framework around it. So let's get started on the topic of politics and investing. So the first thing that I think is really interesting here is that, a question that comes up is it just me that I feel like I should be, more conservative when it comes to my money around elections? Your clients are not alone in thinking that way. Investors, in fact, do become more conservative during election years. So this is looking at average net funds flows by year of presidential terms, going back to the early 1990s. The dark blue is equity funds, call it net inflows, versus the actually I want to make sure that's right. Yeah, versus the light blue is the money funds. The colors are way too close. Maybe you can't even tell the difference. So the one on the left here, for instance, during presidential election years, there's less net equity funds versus money funds. More money is going towards money funds because people feel nervous and they want to keep it in a safer place. Versus the year after the election, net inflows to equity funds tend to be significantly larger than money funds, right? So you're not alone in thinking, is it just me, or clients or investors or prospects seem to be a lot more conservative, not when it comes to their politics, but when it comes to their money? Yes, that definitely has been the case. So we already have an uphill battle from the behavioral aspect of people wanting to move towards safer asset classes during an election year. But as you all know, stocks have risen through both regimes, right? A hypothetical investment of $1,000 in U.S. stocks back in 1926, would have yielded $8.96 million by June of 2020. And we had a number of Democratic and Republican regimes throughout that, right? So when it comes to who's in power, has not been as relevant in the past as many people might think. But I think this chart, is the one that's the most powerful. I mean, this is, I think, pretty powerful in the sense that it's simple. This is when they want, when that client or prospect wants to get more in the weeds, because often they start going down this rabbit hole of like, yes, but what if you end up with a Democratic Congress and a Senate that's Republican and then a president that's Democrat? Then we're doomed. Or what if the Republican president stays in place, but then you have a sweep of Democratic Congress and Senate, right? And they just got to get down this rabbit hole. And So this chart is a great way to just kind of nip it, right? So this looks at the correlation between U.S. markets and each of these regimes, between election outcomes and market returns. And this is put together by GSAM, by Goldman Sachs. And essentially what they found is that if you look since the 90s, what you find is that there has been basically no correlation. Obviously, a perfect correlation would be one. There's literally just no correlation between market returns for the next year of the election and if there was a Democratic Congress or a divided Congress or Republican Congress or essentially all different configurations. There's just no relationship. Now, that doesn't mean that the market might not be volatile around election day, even a couple of weeks after election day. But the reality of it is, unless people need that money within the next couple of weeks after the election, really doesn't matter to them, right? It doesn't really matter. It doesn't affect their goals when it comes to what the investments are supposed to do, which is get them to retirement or et cetera. This is one of my favorite charts. This looks at 3 hypothetical investment strategies during an election cycle going back to the 1930s, so 22 cycles. This one's actually from the Capital Group. And basically what they found is that the best outcome is if you just basically stay invested, right? Fully invested, 10K, you end up with 15.8 on average during that 4-year holding period. Next in line would be consistent contributions, but actually have done fairly well as well, meaning you contribute throughout the 4 years. And then obviously the worst outcome would have been to sit on the sidelines. And this, by the way, this is heavily skewed towards the years like the 70s, 80s, and even 90s, where a savings account would still yield you either high single digits or double digits, right? So if we were to run this calculation going forward, my guess is that sitting on the sidelines would not even look as strong or as good as this type of returns, considering interest rates are essentially at 0. So great chart to kind of share with them. Look, the reason that I'm not changing your investment portfolio during this election and even over the next couple of years, because depending on who wins, is because actually being fully invested historically has been how you actually get the best outcomes. And the one thing that I usually use for this type of question around, well, what if we just get out now and then get back in, is when you sell out of the market, you have turned one decision into 2 decisions, because now you sold and now you have to figure out when to get back in. And as you know, for investing, it's hard enough to make one right decision. Now you have to make 2 right decisions. And so from that perspective, if you sell and then the market actually rallies, and now you're trying to decide when to get in, I know a ton of prospects that have basically told us that they've been sitting on cash since 2008. And I'm sure you guys have seen these cases, and you're like, why? And they're like, well, I was waiting for the right time to get back in. And every time I waited for a pullback, the market just kept going higher, right? So it's a great slide to just show them, look, if you stay invested, you're going to get the best outcomes. Okay, so switching gears from the things that are called outside of your control to the things that you have some control in the sense of how you allocate your money. So one is policy decisions on interest rates affect the consumer and the investor in a significant fashion, right? More than who's elected as a president. So I love using this chart, especially when you get people that say, hey, look, I have $1 million, but I want to set aside $500,000 in cash, and I just can't get myself to invest more. This is a great slide to show, right? So this is income earned on $100,000 in a savings account going back to the 90s. So the bar is showing the income generated in a savings account, and this is on an average savings account. So it's not like the highest yielding one at that particular time, versus the darker line that cuts across, the bar that cuts across, is looking at inflation during that period in time. So for instance, back in 2000, $100,000 in a savings account would have yielded $6,000 a year in income, while inflation was below 3%. So it's actually a pretty good return, right? You're getting close to 3% or a little bit more than 3% net of inflation by just sitting in a savings account. Versus today, if you invest $100,000 in a savings account, you're going to get, at best, in a high yielding savings account, you're going to get maybe $400 a year, $500 a year. On average, is actually 220, while inflation is actually between a 1.5% and 2%, right? So after inflation, you're losing the value of your money. So for those clients that are sitting on half their investable assets in cash, is a great way to kind of display to them, look, I get why you're thinking about it this way. For many decades, it actually wasn't a horrible idea to keep a certain amount in cash because inflation wasn't eating the value of your money. That's not the case today. It actually hasn't been the case for a number of years. We're sitting on cash, essentially you're losing the value of your money. And the other aspect that I tie this to policy, and especially the elections, is the central bank is not going to change regime overnight, because either if Donald Trump gets reelected or Joe Biden wins the election, the central bank is not all of a sudden going to say, you know what, we're going to raise interest rates to 4% because X, Y, and Z happened. They've already told us that they're not changing interest rates this year, and they've actually already kind of explicitly told us that majority of the voting members believe that we're not going to raise interest rate all of next year, right? So from a uncertainty standpoint, when it comes to the central bank, they've been very clear they're going to keep interest rates very low. So that's bad if you're a saver, right? If you're just sitting on cash. It's not so bad if you're looking to refinance your mortgage or buy a second home or get a line of credit. So that's obviously where you could kind of pivot the conversation to say, well, look, this is actually not going to change. And we do have some control around what we do with this type of scenario, right? We could optimize for the fact that we have much lower interest rates now than we used to. And then obviously the other one that matters, and matters a lot when it comes to what political parties in power, is taxes, right? So under current administration, corporate income taxes are 21. They were actually higher, right, at 28. President Trump lowered it to 21. Social Security payroll tax is 6.2. Under President Biden, the proposed plan is to move corporate income taxes higher, Social Security payroll taxes to move up higher for the wages above $400,000. Not to get into the weeds, because some of you are actually, if your CPAs are going to know a lot more than me on this particular topic. But overall, I think what the key messaging here when it comes to prospects or clients is there are things we could do now to plan for whatever outcome comes next, right? So this is an area where you could take control of the situation and say, if Biden actually gets elected, we need to come up with a plan of attack to make sure that we're optimizing for your current tax strategy, right? So all of a sudden it switches the mindset of the consumer of being paralyzed on the investment side to say, actually, the advisor's right. There are things we could do here, and I'm so glad that I have the advisor kind of be proactive about what the plan is going forward, depending on who gets elected. Okay, so that's just kind of a reminder here, right? Policy does affect your taxes, and this is one of the areas that I feel advisors that do really well with prospects, they kind of pivot to this conversation rather than what the market's going to do when, if Joe Biden gets elected, or if another one is, but what if it's contested? What if we don't know for weeks? Great, do you need that money during those weeks? Oh no, okay, great. So let's focus on the things that we can control, which is, what does the tax plan look like? How is your estate planning? Do you have the right paperwork in place? Do you have the right insurance? Do we have everything lined up? So whatever the outcome is, you're going to be okay. So I'll stop there, right at 20 minutes, and not to dwell on the kind of formal comments, and just kind of take it a little bit more off the cuff here with either questions or if there's specific comments that anyone wants to share. I could actually allow you to kind of jump in with your mic and share as well if they're not just specific questions. So let me see if there's any questions right now. All right, let's see. Okay, so one of the questions that I'm getting here is how often are advisors not winning a client because of this type of uncertainty, right? And so we do have a lot of data on this. The number one reason when it comes to not hiring an advisor right now, putting aside the, let's put it this way, controlling for what the usual reasons, which is, well, one, they hire somebody else, right? They hire Fisher or they hire Morgan Stanley or whatever. Another one is essentially they were just still in kind of the research phase. They were not really to pull the trigger. The other one is price. Hey, you know what? Vanguard is, charging me 30 basis points, and I realize I don't need as much high touch as I wanted. Those are usual suspects that essentially someone would not win a client. The other one that has come up the most, call it from a thematic standpoint, is delaying hiring somebody because of the election. Now, the good news is that the election's around the corner. And one thing that I've learned just kind of over the last 20 years is the consumer will always find the next reason why they're not going to invest, or the next reason that they're not going to pull the trigger and hire an advisor. I remember during the European crisis, every time, the Greek debt, they were going to default, and people are like, I'm going to wait for this to roll over. And then it was Italy, and then that passed, but then there was concern on high yield. Then it was oil prices, which also affected high yield. And every time, people are always looking for an excuse not to invest or not to pull the trigger on a decision. This is just one of them. I'm sure as soon as we get past the election, there'll be another new excuse, right? So I think as an advisor, when it comes to new relationships, the goal is to basically say there's always going to be a reason why you feel nervous about investing, always, every year. And once you kind of get them over the edge of saying, well, let's focus on things that are under your control and the things that I could help you with, such as tax planning, financial planning, estate planning, insurance planning, etc., that tends to reframe the conversation of like, yeah, actually, I don't know why I wouldn't hire someone to help me prior to an election if I don't need this money over the next 4 weeks. Okay, so that was the first question. Waiting to see if there's a couple more. Oh, I see a question here. Will this deck would be shared afterwards? Yes, we will make sure to share this with the people that registered for the roundtable. We'll make sure to kind of send it to everybody. All these slides, we actually at the bottom has the source. So if you want to basically either recreate them or use ours, it has the source. If you're going to use exactly ours, make sure to source us as well. But yeah, all this slide deck will be shared with everyone that registered. Any questions, comments? Anybody else? All right, quiet crew. Give it another couple minutes to see if anybody else has anything to share or questions. If not, we'll wrap it up. Make it efficient. All right. I think everyone's kind of on the same page here on what how to use these, and there's no kind of comments or suggestions or questions. So we'll wrap it up here. Hopefully it was helpful. As I mentioned, we'll share it with everybody afterwards, as well as the video. If there's any questions, maybe some people didn't want to ask in front of others or whatever, just reach out to me. My email, or reach out to the team, Alex, Jake, and the rest of the concierge desk if there's any questions. We have a ton of data around essentially how to address this and what tends to be what works best to improve chances of either winning new clients or keeping existing clients from the edge of pulling out of the market. So please reach out if you have any questions, comments. We're always here to help in any way that we can. All right, so we'll wrap it up there. Thanks everyone for showing up, and we'll see you next time. Take care.